Over the next decade, if you still focus only on the Fed when investing in U.S. stocks, you may already be behind. For the past 15 years, we have almost formed a mental habit: when the Fed cuts rates, stocks rise; when it hikes, stocks fall. But in the future, this logic may be rewritten.
A key reason is the policy approach of new Fed Chair Kevin Warsh. He prefers to let the bond market set long-term financing costs, rather than having the Fed use tools like QE to artificially suppress long-term rates.
In his view, this can continue to curb inflation while minimizing the impact on economic growth.
In other words, he trusts market mechanisms more than artificially low long-term rates.
This means that what really matters in the future may no longer be just the Fed's short-term rates, but three variables. The Fed influences short-term rates, the bond market largely determines 10- and 30-year Treasury yields, and the U.S. Treasury affects debt supply through its issuance pace and maturity structure. These three forces will jointly shape corporate financing costs, stock valuations, and overall market liquidity.
So, going forward, investors cannot just ask, did the Fed cut rates? They should also ask, where are long-term Treasury yields heading? Is the Treasury still issuing large amounts of debt? Over the next decade, the investment logic may shift from don't fight the Fed to don't fight the bond market. In the past 15 years, the Fed largely defined the market. In the next 10, the market may be defined by the Fed, the bond market, and the Treasury. This reflects new Chair Warsh's new approach and achievements.